Hi everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're discussing how investors are navigating the data void with secondary reports during a week of renewed market volatility and an ongoing government shutdown. With key federal reports delayed, these secondary indicators are taking on heightened importance, offering a mixed but informative look at the U.S. economy for the week of October 13th through the 18th. First, let's look at small business sentiment. The NFIB Small Business Optimism Index declined in September, dropping 2 points to 98.8. This was a bit lower than expected. Small businesses, which employ about 50% of the U.S. workforce, are feeling significant uncertainty, a level that has surged to its fourth highest level in over 51 years. Their top concerns remain labor quality and taxes, with supply chain disruptions and inflation also weighing heavily. On a brighter note, however, the net percent of owners reporting higher profits hit its best level in nearly 4 years. Now, moving to regional manufacturing, we see a split picture. The Empire State Manufacturing Survey for New York increased modestly, rebounding by 19.4 points to a positive 10.7. This was significantly above the forecast. In sharp contrast, the Philadelphia Fed Manufacturing Index fell dramatically, dropping 36 points to negative 12.8, its lowest level since April, signaling a sharp slowdown in regional activity. Despite these contradictory headline figures, both regions reported similar trends in inflation. Prices paid and received moved higher, confirming persistent price pressures across the sector. Furthermore, firms in both regions expressed greater confidence over the next 6 months. Next, let's shift to the housing market. Builder confidence saw a notable improvement this month. The NAHB Housing Market Index, which measures builder opinion, jumped 5 points to 37. This reading was the highest since April and the largest monthly increase since January of last year. This uptick was fueled by reduced mortgage rates and anticipation of easing by the Fed. All three components of the index, current sales, future sales expectations, and prospective buyer traffic, improved significantly. Finally, on home values, the Zillow Home Value Index showed that U.S. home values increased for the first time in 7 months in September, rising to $363,932. This represents a small nominal increase month over month and year over year. However, when we adjust for inflation, the real or inflation-adjusted home values has fallen for a 17th straight month, with the real index now at its lowest level since March 2021. So how did the market react to all of this? The ongoing government shutdown is causing a data blackout, which has left the Federal Reserve, quote, flying blind, without access to critical official reports on employment and inflation. However, despite this limited visibility, the market shows near certainty in the Fed's next move. The CME FedWatch tool currently shows a massive 96% likelihood that the Fed will cut rates by 25 basis points at their next meeting on October 29th. Markets are also pricing in another 25 basis point cut at the December meeting and 3 additional cuts across 2026. The S&P 500 was volatile, but finished the week strong, ultimately posting a 1.7% gain from the previous week. It had its largest single-day gain in over 4 months on Monday, though it seesawed through the rest of the week. In fixed income, the 10-year Treasury note briefly dipped below 4% for the first time in over a year last week, finishing the week at 4.02%. The 2-year note also saw its lowest level since September of 2022, but ended the week at 3.46. Due to the ongoing government shutdown, the economic calendar remains sparse, making the reports we do receive all the more important. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Charts section.